What's up, YouTube? In this video, we're going to be covering the 5 biggest mistakes to avoid if you get paid in any form of stock at work. And this video is going to be important for you if you receive any type of award related to stock from your company. That includes things like stock options, RSUs, or anything similar. This video is going to be super important for you to watch and pay attention to because I've seen a lot of people make some of the mistakes that we're going to be covering in today's video, and I want to make sure that you're avoiding these because stock awards can be a huge hack for building lots of wealth and helping you reach your goals. This subject is actually my bread and butter because at the start of my career, before starting my own financial education company, I was a financial advisor, and on the team I was on, we were actually in charge of administering or basically keeping up with the stock award platforms for some of the largest companies in the world, like Disney, Amgen, Coca-Cola, Home Depot, to name a few. So I was having these conversations every single day with clients, and I want to make sure that I'm having it with you today. So without further ado, let's get into the 5 biggest mistakes that you want to avoid with the stock awards that you're receiving at work. So number 1 is simple, but it's really important. Mistake number 1 to avoid is not understanding your awards. I see a lot of people make the mistake, maybe they get hired somewhere or you receive some sort of promotion. They're like, hey, we're going to start giving you some stock awards. And you're like, great. And HR is like, make sure that you sign this document, and you log in and click the thing, and you don't understand what you're clicking on. You don't understand what you're agreeing to. You do not want to do this, right? So there's all sorts of awards. We're not going to go into a ton of detail in those different awards in today's video. What I want you to understand is, at bare minimum, you want to understand, number 1, what type of award is it, right? Is it a stock option? Is it RSUs? Are there performance units? Because these different types of awards work in different ways, and you need to do different things to make the most out of the money that you're receiving. Because again, this is a part of your pay at work, and a lot of people treat it like it's not, because it's not like a W-2 paycheck, but it's a very, very important part of your financial situation. So at bare minimum, you want to understand, what type of award is it? Is it a stock option? Is it non-qualified stock option? Is it an incentive stock option, ISO? Is it a restricted stock unit? And of course, the vesting schedule. So the vesting schedule is a fancy way of saying, how long do I need to be with the company in order for me to actually be able to take advantage of these awards? Often you'll be granted or gifted a certain amount of shares, whether it's stock options or restricted stock units, whatever it may be, but you have to be with the company over a certain period of time in order to be able to actually get those benefits. And the company does that to try to keep you working for them, right? So there's a term called the golden handcuffs because of that. But again, at bare minimum, we want to understand, what type of award is it? Is it a stock option, and so on? What is the vesting schedule? How long do I need to be with this company to actually get these shares? And are there any additional requirements? Are there any kind of other things that have been thrown into the deal that you need to make sure that you're aware of? Because again, this is your money. So if you're wondering, like, where do I actually get this information? There's something called a grant document that you receive whenever you are gifted these awards. And that is usually on the portal of the website that, you have to log into to actually see your different awards. So we'll take a quick look at what that looks like here. So here we're just looking at a quick example of what a stock award or a grant document looks like. And you can see this outlines a lot of the basic but important information. And to be honest, this document is going to be super, super long, and there's all sorts of legal speak, and you don't need to understand all of it, but you understand the main points. Here you can see that we're looking at a grant document for stock options, and this person received 1,500 stock options. So they had the ability to buy 1,500 shares of their company stock at the strike price or exercise price of 1 cent or 1 penny per share, with the total or with the expiration date, meaning the date that you have to take action by, being March 13th, in this case 2018. And you can see all sorts of other types of information, like the vesting schedule. You can see the vesting schedule. These shares will start to vest in a series of 48 successive equal monthly installments measured by the vesting commencement date. So that's a fancy way of saying that these shares will start to vest over 48 months, basically. So again, just a really high level breakdown of what this looks like. Again, you can find this document on your portal. You can ask HR for it, but this is where you're going to get this information. All right, so moving on to mistake number 2. This is a big one, is not understanding or planning around taxes. So yes, taxes can definitely play a role in the awards that you receive, and you want to make sure that you understand and you're planning around how these taxes work. So again, we're not going to get into all the details, but typically there's different types of taxes that can apply. One of those being ordinary income tax, specifically with things like restricted stock units, RSUs, and then capital gains tax if you're selling shares for more than what you got them for, basically. So as a quick example of this, let's say that you have $100,000 of shares from your company that vested to you this year. The IRS is going to treat that as you receiving $100,000 of extra income, basically almost like the company paid you $100,000 extra in cash, essentially, for these shares. And as you can imagine, that could potentially push you up a tax bracket. And you want to make sure that you're understanding this in advance before these shares are actually vesting to you. And there's all sorts of things you can do here. Again, we're not going to go into all the details, but one of the simplest things you can do is review the withholding rate or the tax rate that you've elected. So if you're concerned about having a huge tax bill, one thing you can do is potentially increase how much you're withholding for taxes. And you can do that through the portal as well of the stock award platform. You can look at potentially taking the money in shares or cash. Again, the tax impact is still going to be there, but you have the ability when it comes to the withholding rate, you can say, I want to receive this in shares, please withhold this percentage of shares, or I want to receive these shares as cash, please withhold this percentage of that money, of that cash from these awards. And of course, this all comes down to tax planning and being very strategic. But mistake number 2 is not understanding the tax impact of these awards and being smart around minimizing how big of a tax bill you can get because of these awards being a part of your pay. Okay, so mistake number 3, and this is a huge one I see all the time, is owning too much of the stock. And a lot of people think this is different because from just owning any other stock, because they're like, well, I work at the company, I understand what's going on, and that's great. And I think you should understand what's going on with any individual stock that you own in your portfolio, but the risk is still the same, whether you work at the company or not. Owning a lot of one stock in your portfolio can be risky because, as you know or may not know by now, individual stocks are generally a lot more risky compared to things like index funds or ETFs because the movements in price can be a lot sharper up and down. And there's a fancy term for this in the investing world called concentration risk. And I'm going to share a quick quote with you that I share with clients and students all the time when it comes to this specific subject. And it is that concentration builds wealth quickly, but it destroys it even faster. So a lot of people like the idea of owning a lot of one stock because it can make them a lot of money fast. And that can be true, especially if you're working at a company that's growing quickly. But the flip side is even more true. And what a lot of people don't realize about success in investing is it's not necessarily about how much money you make. Obviously, we want to be making money, that's the point. But it's also about how much money we don't lose. And when we're talking about individual stocks, we can see some massive, like truly catastrophic losses if you're not paying attention to this one particular thing. And we're going to look at an example of that here in just one second. But as a rule of thumb, again, this may or may not apply to you. It all depends on your specific situation. But as a rule of thumb, you want to try to avoid having more than 10% of your overall investable net worth or your overall portfolio basically in one individual stock. And that includes your company stock or any other stock for that matter. So let's look at an example of why this is a big deal. All right, so here we're looking at Meta stock, formerly known as Facebook. Obviously, it's a massive, massive company, and the stock has done really well over the long term. But I want you to imagine something really quickly. Let's say that all of your net worth is tied up in this one stock. You're a Facebook employee. You've been with the company for a long time. You've received the stock options. You've received the RSUs, whatever it may be. What I want to look at here is something called max drawdown, which is just a fancy way of saying what's the maximum percentage that the stock has fallen over any period of time. Here we're looking at the maximum drawdown for the stock for the past 5 years being over 76%. So I want you to imagine something for 1 second. I want you to imagine, again, all your money is in Facebook stock or Meta stock, if you want to call it Meta still. And then all of a sudden you see that amount of money that you've worked so hard to accumulate over the years drop by 76%. Right? 76% is a massive, massive loss. And of course, it takes time to come back from that if you hold on to the stock, but a lot of people would have panicked by that point in time and sold it anyway. So this is more on the extreme side, but you know, there's companies that go under, right? And I'm not saying yours will, but whether it's 76%, 10%, 20%, whatever it may be, the losses can be really, really big if you're not paying attention to this. All right, so moving on to mistake number 4 that I see often and I want you to avoid is treating your stock awards like a backup savings or basically like an emergency fund. So I've seen a lot of clients and students in the past that are receiving these awards, maybe the RSUs, and they're collecting these shares over time. And, you know, something comes up, they got to pay for a vacation or the water heater goes out or whatever it is, and they don't have emergency savings. So what they do is they tap into their shares. They'll sell some shares to make ends meet or cover the expense or whatever it may be. And while it may be nice to have that stash of money sitting there, that's not always a good idea, because number one, the purpose of an emergency savings fund is to be able to cover things like that, because that's, again, you want to be defensive as well as offensive with your investments and strategy. But we also need to be thinking about taxes here. We just talked about taxes a second ago, but what happens is if you are selling shares and some of those shares are at a gain, you might be triggering capital gains tax. So even though you're able to come up with the cash to cover the emergency or pay for the vacation or whatever it may be, what might have happened is you might have triggered some serious capital gains depending on the amount of money that you or the amount of shares that you sold. And you might have a decent tax bill come April next year, and this could have been avoided with some careful planning up front. So taxes is one side of the equation. The other side of the equation is you could also just be giving up a ton of growth in that stock long term by selling the shares too often, right? As a rule of thumb in investing, you never want to sell investments too early, because it's like you're cutting off that growth. And if you're working at a company that is growing quickly, specifically maybe like a tech company, like a lot of my clients and students work at, you want to be careful, because you sold some shares and you got some cash, and that's great, but you also have to think about the long-term impact of that. And I want to show you just a simple example of how powerful this can be. All right, so here we're looking at a cool chart together. This is the value of $1,000 invested in Amazon stock over the long term. So I want you to imagine that you were an employee at Amazon. Back in the day, you were receiving these shares, and you had $1,000 in Amazon stock. You didn't think much about it, and you had a vacation that you wanted to take. You didn't have a sinking fund to cover it, or maybe you had an emergency come up and you sold your shares instead of having the emergency fund established in advance. I want you to look at how much this $1,000 has grown by over the past, in this scenario, over the past, or in this scenario, over this 20-year period. It went from $1,000 to almost $500,000. And this isn't you buying more shares. This is just the initial $1,000 that you had in Amazon stock. So the point here is selling shares too early or without a good enough reason can massively be detrimental to the long-term growth of your investment portfolio and also your goals as well. Okay, to wrap it up with mistake number 5, this kind of ties it all together, is not having a plan for the shares or the awards that you're receiving over time. So a good plan takes into account all sorts of things like, how do these shares help me reach my goals? How many of these shares is appropriate, or how much of this money is appropriate to have in my investment portfolio? If I have too much exposure to it, like we talked about just 1 second ago, how do I reduce exposure to this stock so I'm not setting myself up for massive amounts of risk without triggering a ton of tax along the way? How do I view these shares as a part of my family's goals, my financial goals, and my future? So these are really important questions that you need to be asking yourself if you are a part of a company that is paying you in stock, and maybe you're moving up in the company and the stock's going to be a bigger part of your compensation over time. This is something you want to start figuring out now, because the sooner that you do so, the more comfortable you'll be with the subject, and also the better plan that you'll be able to create for yourself in the future when it comes to the goals that you're looking to accomplish and what this money can do for you. So mistake number 5 is not having a plan that clearly ties these shares into everything else that you're doing financially and the goals that you have set for yourself and your family. So these have been the 5 biggest mistakes to avoid when it comes to the shares and the awards and the options and all the things you're receiving at work. It's a great benefit, and depending on your position and the direction of the company, it can help you build serious amounts of wealth and help you reach your goals potentially even sooner. But these are massive pitfalls that you want to avoid on your journey. So next steps from here are, if you're watching this video and some of these things you can relate to, and you're like, I have these awards, I know that I should be doing more with them, I'm making some of these mistakes, and I just feel lost, I need guidance, I need help. What we can do is, in the description to this video, and I'll also leave it in the comments as well, you'll see a link that you can use to schedule a quick one-on-one consultation with myself. We can sit down, have a chat around what you have going on, help you get some clarity and some confidence around the moves that you're making with these awards and your investments in general, and make sure that I can point you in the right direction. So again, the link to that's going to be in the description to this video. You'll also see it in the comments. But hopefully you found this video helpful. Hopefully you learned something today. Hopefully it gives you something to think about. If you did find it helpful, make sure that you give this video a like. Drop a comment down below. Let me know what you found most helpful. Again, take a second. If you need some help, I'm happy to meet with you. Click that link in the description to schedule a quick one-on-one with myself so we can sit down and talk about your situation a little bit more. But besides that, thanks again for taking the time to watch this video, and I'll see you in the next one.